Welcome to Educational Alpha. CAIA CEO and host Bill Kelly brings you on-the-ground conversations with business leaders, educators, coaches, and industry colleagues from around the globe. In this episode, Bill talks with one of the earliest CAIA designation adopters, Dick Pfister, founder and CEO of AlphaCore. Pfister's storied career in finance began as a floor trader at the Chicago Mercantile Exchange and has taken a remarkable path that may just parallel the evolution of the industry and client expectations of alternative investments on portfolio outcomes. Listen in.
Welcome to the latest edition of Educational Alpha, where the investor's edge starts with informed consent. I'm your host, Bill Kelly, and today I'm joined by Dick Pfister. Dick, great to see you again.
Good to see you too, Bill.
So, Dick, this is not meant to be an infomercial for CAIA, but you and I have known each other since the very beginning of CAIA, and I'm just starting my 10th year here. And you're charter holder number 10, so the symmetry there. Really charter holder number 1, but early adopters. So great to see you again on this platform. And maybe we'll start by just a bit of an introduction of your background, so the listeners know a little bit about the perspective from where you're coming.
Well, my pleasure, and thanks for having me again, Bill. It's funny you mentioned I was one of the early CAIA members, and it kind of just reiterates that I'm getting much, much older, Bill. And I guess that's good if you look at it in a certain light, because it gives you a little bit of background and experience that you may not have had. But the CAIA program has been a part of my career now for over 15 years. So it's exciting to have you at the helm here, Bill. So I'll give you my background. I got a college degree, finance degree, and started my career on the floor of the exchange, the Chicago Mercantile Exchange. And that's really where I got more and more interested in the world of diversified strategies or hedging strategies, because I worked at Dean Witter in the early 90s and met some of the best names in the business with regard to risk management. And those are names, Bill, that you're probably familiar, like Paul Tudor Jones and George Soros and Bruce Kovner. All of those managers who are quite famous today weren't that famous back in 93, 94. They were hedging their portfolios using futures, very early days, and gone on to be kind of best of breed in what they do. And so that's what got me hooked on the world of institutional risk management, if you will. And that led me into the world of alternatives. Some people would define those as hedge funds or private markets. And as I kind of grew up in this industry, realized that there were a lot of ways that the individual investor was kind of being shut out of the world of alternatives. And I got very interested in kind of allowing or democratizing access into the world of alternatives. I met my former business partners, and we launched a firm called Altegris back in 2002. And that stood for Alternatives, Integrity, and Risk Management. And what we did is we created the first platform to allow access to individuals into these managers that had much higher minimums. We would pool assets together and allow our clients to get into managers that would have been $20 million minimums. They could now access at $100,000 or $250,000. And that was early days of kind of the internet. They're putting private placements on a public website. And the good news is over time, more and more vehicles have become available, not only to the institutions and endowments, but now down to the retail investor, including mutual fund structures, alternative mutual funds, interval fund structures, BDCs, as well as limited partnerships. And I chose to launch my own wealth advisory firm about just under 7.5 years ago now, because I thought there was a void in the truly independent advisor space, which would incorporate traditional stocks and bonds, and then in a meaningful way, adding in alternatives to help diversify those. And that's what we do at AlphaCore.
A few interesting themes there, Dick, and maybe going back to the days of Altegris preceding AlphaCore. Certainly the industry's changed a lot, and we've had a lot of eyeballs on the same opportunities, which usually rinses out the alpha component of it. And we have dispersion is very, very high from median to top quartile. The median returns are undifferentiated. Managed selection matters a lot. And trying to make something of this is much more difficult. So the whole concept of diversification, once a free lunch, maybe it still is, but you have to work a lot more hard to find it. But how have you found the evolution of the industry and client expectations? And are they still looking at alts as less maybe of a risk mitigator, maybe with an alpha component, as opposed to a pure on alpha engine when they don't like what the 60/40 is necessarily going to deal them in these coming years?
Yeah, I think you hit it on the head there, Bill. There's definitely been an evolution of when I first got into business 25 years plus ago. There were kind of these kind of swashbuckling big risk takers that would be concentrated positions, and they'd move currency markets, they'd move interest rates, they'd move commodity markets. And as the institutions gotten more and more involved in allocating to the world of alts, they started to call it quote unquote institutionalize the entire alternative business, which meant you had to apply good risk management. You had to offer, if you were going to offer non-correlated returns, they had to be repeatable. They had to have a certain differentiating risk factor involved when you were going to do that. And that's on the more liquid strategies. As you got into the less liquid private markets, like say private equity, venture capital, private credit, private real estate, that too evolved and became more institutional, and fees got compressed. And in the middle of all that, let's say over the last decade or so, as we all know, worldwide central banks were lowering interest rates, and volatility was compressing and compressing. And so being in a traditional 60/40 over that time window, you were well served. And the world of alternatives, which was trying to extrapolate returns based upon dispersion in equities or dispersion in various markets, they were having a harder and harder time finding those opportunities. And so some of those strategies were kind of pushed out of the asset allocation models because they weren't provided the opportunity that they would have had, let's say, in the 90s. But today's environment with elevated volatility, elevated interest rates, and the elevated inflation that we're dealing with today provides that opportunity again for those strategies to do well and provide true diversification, let's say, call it non-correlation in this market. We don't think that's going away anytime soon. And I think the good news for the investor is they can provide stability to their portfolios without trying to hit huge home runs and knock the ball out of the park with outsized returns, consistent returns with most of these managers are delivering today. And they're doing it in an institutional way, and in some cases, even a registered way, registered with the SEC as well.
I want to bring that whole discussion, Dick, toward liquidity. And if you look at the ultimate public market proxy, pick any equity mutual fund, and you look at the return on the label of that fund or in the prospectus, the average retail investor typically is captured 200 to 300 basis points less than that return. So they're always tacking in and tacking back out. Something you said a moment ago. If you could lower the volatility, lower the drawdown risk, maybe the investor stands a chance to be fully invested. But then when it comes to alts, going back to the global financial crisis, our resting pulse seems to be as an industry, you know what? We'll create a liquid proxy for that. We'll create a liquid proxy for real estate, a liquid proxy for hedge funds, etc. And even if it can be done, and you can do it more easily in the long-short equity space than you can in the real estate space, witness BREIT of recent vintage. But should we be talking to the investor about the importance of long-termism as opposed to giving them what they think they want, which is liquidity, when that could be maybe the undoing of wealth creation?
Yeah, I think you hit that nail right on the head. That, to me, the mistakes that I've seen investors make in the world of alternatives, whether that's the retail investor all the way up to the biggest institution, is they have a mismatch of expectations on not only potentially liquidity, but also return. And when they have that mismatch, they've kind of miscategorized or mislabeled the strategy. And that leads to, I'll call it unrest or dissatisfaction of the strategy itself. To me, when you include, and I think generally this is where the market is going, if you start to include less liquid strategies, whether that's private real estate, private credit, private equity, and then you also include some hedging strategies, say long, short, merger arb, trend following, that gives the entire portfolio the ballast and the ability for the individual investor to have a much longer term mindset, right? Because those should provide the protection in a down market. Those should give the portfolio that risk mitigation, and therefore the end client should be like, oh, okay, I can hold this private real estate because that's what's given me the protection on the downside. And like you said, you don't necessarily need to be offering quote unquote quarterly liquidity on a private real estate. vehicle. What the investor should know, it's still private real estate. It doesn't really have, quarterly liquidity on a readily basis. So I think there's somewhat of a mismatch there, but if you're educating the investor well enough, they should know that.
And does our industry do a good enough job about starting with the liability side of that balance sheet? And I look at the late great David Swenson or any sophisticated allocator. They look at who's going to call their capital and when. And I think the individual is really on some levels, behavior aside, no different than that. And if you've got a fair amount of investment dry powder, to think that some of it cannot be invested in a less liquid vehicle, I think you're not understanding the duration of your liabilities. Do we give that side of the balance sheet enough respect and attention?
I think it's always a work in progress. I mean, I think we're much better as an industry today than we were 20 years ago, 10 years ago, but it's a constant evolution, right? I think we've always got to be talking about education and educating the client, right? Because what the individual is always hearing and seeing is what's happening in the press. They're listening to the various news outlets, whether it's Bloomberg or CNBC or anything on social media. They're talking about liquid things primarily. And so they have to constantly be reminded that there are other ways to access less liquid return streams that will be beneficial to your portfolio. And that's a constant battle, a constant educational process. There's much greater materials now. There's better tools to deliver that information. So, I think we've gone a long way, but there's still probably a long way to go with that. But the good news is that that's happening.
And one more door I'd like to open, I don't know if you do much in your practice, is digital assets. And not so much on cryptos, if you want to talk about that, great. But the advent where any asset could be fractionalized. It could be a piece of art, it could be a patent, it could be a building. And this next generation coming up, and maybe your client base as well, and our members, our future members, are much more tech savvy, tech natives. And it sounds very foreign to us because I'm used to holding a Disney stock certificate in my hands. But tomorrow's stock certificate is perhaps that digital asset. Are you seeing a lot of demand and conversation? And what are your views about the trend moving in this direction?
I think that's a natural progression. I think it's almost inevitable. All right, it needs some adoption, but there have been platforms created now, which call it 5 years ago, 10 years ago, the advent of DocuSign and accessing limited partnerships electronically versus using hard copy subscription documents. Right, that was call it innovation 101. This is the next step of that, right? And you could see not only what you mentioned is there are instruments, let's say real estate or currencies, or call it hedge fund limited partnership, private equity limited partnership, that you could be digitalized and accessed that way. And to me, that's going to be the next step, the next phase. And I think it's hard to argue with that, right? It seems inevitable. And I think our industry will adopt it quickly, like it always does, and benefit the end investor as it goes forward.
Well, it's certainly something we're seeing a lot. We're moving toward this unified by Alpha platform, a series of digital badges to try to help the RIA and their end clients solve for blind spots. And we're seeing a reasonably high demand in this space. So it's not going away. And I think oftentimes when people hear distributed ledger or digital assets, it's immediately FTX and don't go near it. And it's much more nuanced and complicated than that. And I think that we are going to have growing pains, clearly.
That's right. That's right. I think, the other thing about that world is that the large banks are already starting to try and adopt that themselves, right? They want to transfer assets in that manner. It's secure. It's got a lot of benefits to it. And I think as that happens, more and more the industry will adopt it as well.
And it's interesting that KKR just came out with their recent fund. I think it was in the healthcare space, a feeder fund based out of Cayman. And they have one of the feeder funds is on the blockchain. And it's going to be very interesting to see how this develops because, back to it's not just BREIT, a bunch of these real estate firms, real estate offerings have had some gating issues that demand has exceeded the tender. But if I think about blockchain, if you and I are in this KKR fund on distributed ledger and I want in and you want out, we have to find each other. It's got to be price discovery. And then we have to figure out, do we like the price? But the fund itself does not have to raise any liquidity. So if I'm a third investor saying, hey, Dick and Bill, you go duke it out on the side, I want my investment uninterrupted, and they can have that cake and eat it too. So I think it's going to be very interesting. Early stages, but I think the plumbing of this next generation could be very interesting and worth paying attention to.
I completely agree.
So, Dick, as we move toward a close, the concept of R squared, should yours be higher than mine because you're smarter than me? I don't think that should be the case, although maybe in this case I'll cede some ground to charter holder number 10. But when I think about leveling the playing field, education should be democratized before we democratize product. And that's what this whole series is about. So maybe giving you the final word in terms of a key takeaway for our listeners. They think about educational alpha and approaching any asset allocation decision with informed consent.
I completely agree with that. And I think there's a component that's kind of been embedded in our industry, and I'm talking about the wealth advisory industry, which is there are certain methods and tools built out in called the broad wealth planning world, which includes running financial plans, doing estate planning, doing insurance planning. That world has an embedded simulation or kind of modeling built into it that would include primarily the two largest asset classes, equities and fixed income. And so when you run back assumptions and do Monte Carlo simulations on those two long-only asset classes, it's inevitable that the recommendation from your financial advisor to the retail investor will be some version of a blend of that. Maybe it's a 60-40 or 70-30. I think that the evolution of utilizing alternatives has to start even at that ground level, to start incorporating these diversified return streams, whether they're liquid or less liquid, so that the end investor gets delivered the product in an educated way, but also gets that diversification that they're looking for when you put together a diversified financial plan.
Yeah, I think an excellent point. And we didn't get to cover a 60-40 dead or alive, which I think is the wrong narrative. And if you can go to your client with 2 levers of diversification, 3 is better, 4 is even better, 5 is even better. So it's more about the concept of diversification has just gotten wider. And you have to have informed consent again to find out what those uncorrelated risk premiums are. But I think there's a tremendous opportunity for the end investor at the end of the day.
Yes. And I think that the good news is that that's happening too. So like I mentioned, it's much better than it was a couple of decades ago. And people have talked about various risk factors and accessing various risk factors. If we can educate and simplify that method and story, I think the end investor is just going to benefit from it.
Dick, thank you. I enjoyed the conversation. Always great to see you. Hopefully live next time.
Yeah, thank you very much. I appreciate you doing this.
I appreciate you. Thank you. Please join us in the next segment of Educational Alpha as we look to always put the investor first through transparency, education, and informed consent.